Hi, so let's continue with the second module, and that is the role and responsibility towards stakeholders. Now, you have to understand that organizations have a lot of stakeholders. Now, this is not the time that I'm going to be telling you about the stakeholders that the companies have and their responsibility or their objectives of each of these stakeholders. These things are something you know already from various studies in relation to that. But the stakeholders are simply the individuals who are affected or are interested in the operations of an organization or the business of an organization and are affected directly or indirectly by the operations decisions of the organization. So what we want to look at for here is the role of the financial manager or the CFO or the senior financial executive in relation to strategy or financial strategy formulation towards the stakeholders. So these stakeholders are going to be affected by various things. So what we want to discuss now is the role that the CFO has in relation to how we can satisfy our stakeholders in relation to that. So the first thing we want to look at is financial strategy formulation. Financial strategy formulation. Now, so what is strategy formulation? Strategy formulation is the process by which an organization chooses the most appropriate courses of action to achieve its defined goal. So when we talk about strategy formulation, it is where we are asking ourselves, what is the most appropriate course of action that will help us to achieve our defined goal. So if it is our goal as a company to become the leaders in our industry, if it is our goal to become or increase our market share this year, if it is our goal to become or to increase the value of the company, then what are the courses of action? Okay, what do we do? What decisions do we make? What activities do we undertake? What various sub-strategies do we put in place in order to help us to achieve those defined goals? Now, this process is essential in an organization's success because it provides a framework for the actions that will lead to the anticipated result. So strategy formulation provides the action plan, it provides the roadmap, it provides the channel, the various actions that a company has to make or has to take, and the various decisions we need to make, the various resources that we need, the various processes that we need in order for us to achieve our objective. So strategy formulation is very key about that. Now, strategy formulation in total is the role of the board of the organization. But when we talk about financial strategy formulation, it is fundamentally the role and the responsibility of the CFO or the senior financial executive or the advisor. So let's look at the various roles and responsibilities of the CFO of an organization in relation to financial strategy formulation. In this one, we will get to understand everything about that. The first role is about investment selection and capital resource allocation. If you remember in our previous discussion, I mentioned that one of the responsibilities of the CFO is what? Involved in the investment decision. So the first thing is about investment selection and capital resource allocation. So what kind of investments do we make? Remember, profit maximizing may not be the only goal of a company. Its stakeholders may want other things. Therefore, other consideration will have to be what? Taken into consideration. One, the ethical consideration when deciding on what to invest in. So we would have to look at the ethical consideration. Now, the fact that a market is lucrative, the fact that, let's say, for instance, we are a mining company, and so we have realized that we can get a gold mine, we can get some natural resources in a village somewhere, does not mean that we can just get up and then go there with our bulldozers and then just demolish everything and begin to mine. So we have to ask ourselves, what is the ethical consideration in relation to what we are going to invest in? if we are going to be investing in that thing and we are going to be mining or exploring those natural mineral resources, then it means that we have to provide alternative habitation for the occupants of that land, for the owners of that land, as part of our corporate social responsibility. Otherwise, we may not be seen as an organization that is ethical, and that may affect our reputation, and that will go ahead to affect our operations as an organization. So the first thing we ask ourselves, apart from undertaking the investment appraisal techniques, we have to ask ourselves, what is the ethical consideration about it? Is it good? What is the moral right of it? We need to take it into consideration, because remember, we are not interested in making money for our shareholders, who are our stakeholders though, but we are also going to be looking at the impact of our investment on the community, the impact of our investment on the society, the impact on our investment on employees, the impact of our investment on the government, and other things in relation to that. Second thing is, what method of investment appraisal should be used? So after we look at the ethical thing, then the method of appraisal. So is it NPV? Is it IRR? Is it APV? Is it payback period? Is it discounted payback period? We have to ask ourselves that thing in relation to that. Third, what our stakeholders will think of, what will be the effect of the investment on return on capital employed and earnings per share? In other words, what will be the effect of our investment on the wealth of the shareholders of the company? So we have to look at the fact that if we are investing in a project, will it increase our ROCE, returns on capital employed, or decrease our returns on capital employed? Will that increase our earnings so that we can increase our earnings per share, or decrease our earnings in relation to decreasing our earnings per share? So we have to ask ourselves that question as well in relation to that. So these are the three things that the senior executive or senior finance executive, or what we call the CFO, helps the business to undertake in relation to financial strategy formulation. That's the first thing: investment selection and capital resource allocation. Second is raising finance and minimizing cost of capital. Remember, I told you about the second decision that the CFO makes, sources of finance or financing decision. So where do we get the money from? But remember, we need to be able to minimize the cost of capital. As we'll be considering later on, we will be looking at, you see, usually we have what we call the weighted average cost of capital, which means that we are going to be getting the money from debt, and we are going to get in the money from equity shareholders in relation to that. If from debt, we'll be interested in calculating the cost of debt. If from equity, we'll be interested in calculating the cost of equity. But what we have to do here as the CFO of the organization is to make sure that the money or the finance that we are raising, at the end of the day, we will be able to minimize the cost of capital. So this is where something about, which we'll be looking at later, Modigliani and Miller, about the issue in relation to increasing the gearing of the company. And what they said is that irrespective of how geared the company is, in other words, even if we increase the debt finance of the company to as much as 99%, the weighted average cost of capital will be falling. Why would that happen? Because you realize that I mentioned that debt is what? Tax deductible. So if debt is tax deductible, then we'll be calculating KD after debt. So if we are calculating KD after debt, at the end of the day, what is actually going to be happening is that we are going to be paying less than what we are supposed to pay. So even though when we increase debt up to 99%, our cost of equity, KE, will also rise. Because the debt is tax deductible, technically at the end of the day, the weighted average cost of capital will be falling. So one is rising and one is technically falling. So at the end of the day, weighted average cost of capital will fall. So when we are asking ourselves, where do we get the money from, we have to also find out that wherever we are getting the money from, we are minimizing the cost of capital of the company. Now, where do we get the money from in relation to the second decision? The organization or the CFO helps the organization to answer some questions. So the issues or factors we take into consideration in making financing decisions. One, are the current gearing level minimizing the cost of capital of the company? That is the first question we ask ourselves. The current gearing level, is it helping the company to minimize the cost of capital? If it is not helping the company to minimize the cost of capital, that means that we may be doing something wrong, or that means that it is not a favorable, a good source of finance for the company. Because for whatever source of finance we are choosing, it has to be able to minimize the cost of capital for our investment. Second, what gearing level is required? Now, every company has its gearing level that it can take, it can tolerate. Now, usually companies may not allow themselves to be 99% geared. Now, 99% geared simply means that you have virtually all your capital of the business is actually loan. It's actually money that you have borrowed. It means you don't really have any investment in the company. You don't really have any ownership in the company. So even though we can raise the gearing level to 99%, we have to ask ourselves, what is the gearing level that is required, that is acceptable, that is tolerable by the company? We need to ask ourselves, maybe the company can tolerate a gearing level of 60%. Cool. If that is what they can tolerate, then we are going to make sure that in raising finance, the debt finance doesn't go beyond 60% of the total capital of the company. Next, what sources of finance are available? What sources of finance are available? In the next module, we'll be discussing the issues about sources of finance. But when we talk about sources of finance, long-term sources of finance here for investment decisions, we can get it from bank loans, we can issue debenture notes, we can issue loan notes, that is if we are listed on the stock exchange market, either the capital market or the main stock exchange market, or we can raise finance from other sources. Or maybe we can go to our shareholders and raise some money, additional finance from the shareholders. So we have to ask ourselves, what are the alternative sources of finance that is available? Next, tax implication. This is a very key aspect, and this is what we will be focusing on. The tax implication of the finance that we are going to be choosing. Because remember, we said that if we are using debt finance, it means that it is going to be what? Tax deductible. So even though we can take a debt of $100 million, the interest we are going to be paying on that debt will be deducted from all our revenue, and so we'll be having a profit and we're going to pay less tax. But if we don't have any debt on our balance sheet and all the money is equity finance, that means that we'll be paying high taxes to the government all the time. High taxes to the government all the time. So it is not a good thing to have only equity share, equity finance on our balance sheet, because we'll be giving more to the government. So we have to ask ourselves, what is the tax implication for the various sources of finance to the company? Then, the risk appetite of investors and management. Very, very important. We will look at this in detail in relation to risk management, but we need to look at the risk appetite of the investors and also of the management. For instance, a company that is geared for about 60%, an investor that is coming, if you issue a debt note or maybe a debenture, that is, you come and subscribe, there are some investors that will not subscribe for it because they are risk averse. They are afraid that, hey, if you are 60% geared, then maybe the business will not do well in the future. But there are some investors, even if you are 99% geared and then you ask for money again, because they know where the business is going, they know who the management are, they know what market you are in, they know the industry that you are in, and they know that you can make this money in the shortest possible time in the future. If they support you, they will what? Give it to you, or they will still give you the money. Then we also have to look at the risk appetite of management. You see, management are naturally trained to be cautious when it comes to investment. And so that is why you have a difference between management and entrepreneurship. there's a difference between who a manager is and who an entrepreneur is. Because a manager or management are there to protect the investment of the shareholders. As such, they will not be willing to take some huge risks. But an entrepreneur will be ready to take some huge risks without even seeing what factors or without even seeing things. But now management are becoming more entrepreneurial, so management's appetites would have to be looked at for in relation to risks to see if they can take in more high debt or they are not ready to risk the business by taking more debt. The next thing is restrictions such as debt covenants. You see, sometimes when you're using debt finance and you sign some debt contracts, the debt contracts will be having a detail or a clause that prevents you from raising an additional source of finance from debt. So until you pay us how much you owe us, you cannot borrow money from anybody else. That is what refers to as the restrictions on debt covenants. So because of such covenants, it may limit us to raise money from debt finance if there is something like that in our already existing debt finance. So we would have to look at it and see if there is anything there. Then implications for key ratios for the company. You have to look at the effect on ROCE, we have to look at the earnings per share, we have to look at the efficiency, and we have to look at other key ratios such as investment ratios of the organization. So this is the second thing about it. The first thing is about the investment, okay? Where do we invest in, and then the allocation of the resources. Then the second thing is raising of the finance, but in raising the finance, we must make sure that we are minimizing the cost of capital of the company. Third is about distribution and retention policy. Distribution and retention policy. This has to do with the dividend policy of the company. Remember again the pecking order theory. Remember the pecking order theory. We said that if you want money, first go to your reserve, retained earnings. So this is where we are now. Now retained earnings are a great source of finance for every business. So should we give dividends away or retain the money? Now to decide how much we're going to be giving away and to decide how much we're going to be retaining would depend on a couple of factors. One, it will depend on will our investments, that is funds funded by retained earnings, increase the share price and thus shareholders' wealth. So will the investment we speculate to be investing in, when we retain money and we don't give it out to the shareholders, the money that we have retained, the fund that we have retained, when we invest it in that project, would it increase the share price and also increase the value of the company? Because if we don't pay them the dividend and we invest in the project, it's going to increase the value of the company, so that if they sell off their shares, they will still get what? That dividend component which they did not receive. So we have to ask ourselves that question first. Second, will paying high dividend means we need alternative finance for capital investment or working capital requirements? That's another question. Because if you are paying high dividends, it means that if you will be retaining less. Now, if you are retaining less, that means you will need what? Alternative source of finance for capital investment decisions or working capital requirements, such as bank overdrafts, such as high trade credit, such as the issues in relation to debenture, loan notes, bank loans, among others. So if we are going to be paying high dividends, do we have alternative source of finance that we can fall on for capital investment decisions and also working capital management? Then the next thing, will paying low dividend fail to give shareholders their required income levels? Now you see, the shareholders of the company or shareholders are usually depend. Okay, so we have two types of shareholders. We have shareholders who are interested in capital appreciation, and we have shareholders who are interested in the day-to-day or the year-to-year survival of their investment. So if we pay low dividend, will it achieve the objective? Because some people invest because they know that at least at the end of every year there is some dividend that they are going to be receiving. Others invest not because they want the yearly dividend. Others invest so that 10 years time they can sell off that business, they can sell off that shares and make a huge sum of money and then put it up somewhere. So when we are deciding how much to distribute and how much to retain, we need to ask ourselves, will paying low dividend fail to give shareholders their required income level? That is a very key question we need to ask ourselves there. Then the next thing is, what are the investors' preference for cash dividend now or capital gains in the future from enhanced share value? So we would have to look at the preference of the shareholders. Now, when we talk about the preference of the shareholders, shareholders usually have two preferences. Some shareholders prefer dividend, and other shareholders also are interested in relation to what? Capital gain. Now, this is dependent on the tax position of the shareholder. Now, so some shareholders, so if they are making the dividend decision, they will be looking at, okay, are we interested in income tax or we are interested in capital gain tax? Now, capital gain comes in as a result of the share appreciation, but the income tax comes in as a result of what? The yearly payment of the dividend. So every year if they receive the dividend, they are going to be paying what? The income tax on that dividend. But is that what they need? Is that what is favorable to them? But some also are interested in capital gain, that is the share appreciation, so that when the share value rises and they sell off their shares, that is when they can only pay the tax once in relation to the investment. So we would have to ask ourselves, what is the preference? Are they interested in cash dividend or they are interested in what? Share appreciation. And this will be dependent on the tax position of the shareholders in relation to that. Now, in the making of such decisions about retained earnings and distribution, we have to look at communication with the stakeholders. Communication with the stakeholders. We need to keep stakeholders informed. Shareholders will need information about their dividend, the gearing levels of the company, the risks. Suppliers and customers will need information about credit policies, pricing policies. Then the internal stakeholders of the company will need information in relation to the current goals and strategies of the organization, so that it can help the employees in the making of various decisions for the organization. So these are what you have to understand when we talk about the next level of decision that the CFO helps the business to make. Then the next one is financial planning and control. Now the CFO will need to develop policies on planning processes, business plans, budgets, and then evaluating performance. So the financial manager or the CFO or the senior finance executive would have to put in place policies to help the company in the planning process of the finance for the company, to help the company in drafting its business plan, to tell the organization what we need to do, budgets, to tell us what kind of expenditure we expect to incur in the next 5 years, what are the various sources of finance available to us in the next 5 years, and all these. And then he will going to be using all these in order to help to what? Evaluate the performance of the organization from periods to periods or from year to year in relation to that. Then the third thing is about management of risks. Now, risk management is key, and so the following needs understanding. The risk appetite of the company, as I mentioned earlier, and how risks are identified, analyzed, planned for, and what? Monitored. So it is very important for us to look at the risks that the company is exposed to. Now, there are a lot of risks that the company is exposed to, or companies are exposed to, depending on the industry they are in, depending on the businesses they are involved in, depending on whether they are doing international trade or they are just trading in the domestic market. So we would have to look at the risks that the company is exposed to, put in place measures and help organization to identify the risks, analyze the risks, plan for the risks, and also monitor the risks. Planning for the risks could be in relation to insuring against the risks or hedging against the risks in relation to that. And then the seventh and the final thing is about the use of resources, the use of resources. it will be important to develop a framework to ensure all resources, that is inventory, labor, non-current assets, as well as cash, are used to provide value for money. So spendings that the company make must be economic, they must be efficient, they must be effective, and they must be transparent in relation to that. So when we talk about the role and responsibility of the senior finance executive or the chief finance officer towards financial strategy formulation, these are the things that we can talk about in relation to what he does for the organization. And as you can trace this back, it goes back to the first 4 things I mentioned: investment decisions, financing decisions, dividend decisions, and then risk management decisions. All of these that we have discussed are actually coming from these 4 fundamental decisions that I told you about, that the CFO helps the business to undertake. Now the second slide we want to discuss briefly, it's about the objectives of businesses and stakeholders. Usually, typically the objectives of businesses can be divided into 2. We have what we call financial objectives and then non-financial objectives. Now, so objectives should relate to the key factors for business success. So the typical objectives that organizations can have could include profitability on investment, the market share they would want to have, the growth they want to have, cash flow, customer satisfaction, the quality of the firm's product, industrial relationship, then the added value. All these are key or typical objectives that businesses must have. But let's look at the financial objectives aspect and then the non-financial objectives. Now, companies may have financial objectives or set financial targets in various areas to help the company to achieve its objective. Companies can set financial targets or objectives on their earnings by looking at what we call the earnings per share or dividend per share, the gearing level, the profit retention, or the operating profitability of the organization. So businesses will set financial decisions for financial objectives, for various segments of the business. But remember, in making these financial objectives, the objective primarily is the maximization of the wealth of the shareholders, because particularly for profit-making organization, the wealth of the shareholders maximization is key. That is what we need, that is what we want, and that is what we want to achieve in relation to that. Then let's come to non-financial objective. Now, a company may have important non-financial objective which must be satisfied in order to ensure the continuous participation of all stakeholders. So without their participation, financial objectives such as maximizing the wealth of the shareholders may be compromised in the future. So even though the primary objective of the financial manager or of the CFO or of the senior finance executive is to help the company to maximize the wealth of the shareholders or to achieve the financial objectives of the company, there are other objectives called the non-financial objectives. In other words, this one don't relate to the company earning money. This one don't relate to the strategies that the company put in place. But this one helps the company to be able to meet the objectives of other stakeholders of the company. Remember, the organization is exposed to various stakeholders like employees, like customers, like the community, like the government, and the employees of the company and management. Right? So if our objective is to maximize the wealth of the shareholders, how do we maximize the wealth of the shareholders if our customers are not satisfied? How do we maximize the wealth of the shareholders if the community we are in is not being positively affected by our business? How do we maximize the wealth of the shareholders if our market share is not increasing? How do we maximize the wealth of the shareholders if the employees or the welfare of the employees are not being met or are not being satisfied? If the workers are not working in a good working environment, they are not giving good salary, they are not giving better incentive, they don't have equipment, the facilities they need to work. How can we then achieve the objectives of the financial objective of the organization? So in as much as the financial objectives are important, the non-financial objectives are also very key things that we have to take into consideration in relation to that. So let's look at some examples of non-financial objectives. The welfare of employees, the welfare of management, the provision of a service, the fulfillment of responsibility towards customers. Remember, customers want cheap products, quality, so they want quality products at a low price, and they want after-sales services. Three things: quality products at a low price, and they want after-sales services. Every customer, irrespective of how much money they have, they want quality. As much as they want quality, they don't want to spend much. As much as they are spending much, they want to have what? After-sales service. So that if they have a problem, they can call on you anytime, and you can come in and solve that problem for them. Then fulfillment of responsibility towards our suppliers. We need to pay our suppliers on time. We need to fulfill the responsibilities that we have towards our suppliers. We need to buy from them the quantities that we have signed contracts with them that we will be buying from them. And we need to also make the relationship well. And then the welfare of the whole organization, of the whole society is also a key thing that we have to be looking at. Other non-financial objectives will include growth, diversification, and then leadership in research and development. Remember, we would have to compromise, we would have to give up financial objectives, certain things in financial objectives, to be able to satisfy the non-financial objective, because you have to use shareholders' money to provide better facilities for the employees. You have to use shareholders' money to make the whole society well, because if you are undertaking corporate social responsibility, that is shareholders' money you are taking to build a hospital, to build a school, to give scholarship to students. So you are actually compromising the financial objective of the company so that it can satisfy a non-financial objective. And this is what leads to what we refer to as conflict of interest all the time in relation to the roles that the roles or responsibilities that the CFO has towards stakeholders of the organization. Now, so if you check your slide there, we have the stakeholders and their objectives there, but I'm not going to be going through any of that in relation to this place, because I've already spoken about them, so you can read those things on your own. Now let's come to a very key slide of our module, which is agency relationship. Remember always that there is what we refer to as the agency relationship. Shareholders or the owners of the company employ management, or if you want, the board, to be able to manage the company on their behalf. So in other words, there is what we call an agency relationship, where the shareholders are seen as the principal, and then the board are seen as the agents of the company. Now, the board of directors or the management of the company are accountable, they are accountable to the shareholders of the company by the preparation of financial statements to the shareholders of the company. Now, their accountability to the shareholders doesn't have to be the fact that they are satisfying their own objective. In other words, there shouldn't be any conflict of interest in relation to that. Any decision that management is making is not because they want to enrich themselves, it's not because they want to make themselves better, but any decisions that they may be making will be because they want to increase the value of the company, or they want to maximize the wealth of the shareholders. So that is what we have to understand in relation to that. Now, one power that the shareholders possess in the right to remove the shareholders the management from office. So one of the things is that since we are the people who employed you, we are the same people who are going to fire you if there need be to fire you in relation to that. But directors' behavior over the years have been queried or have been questioned in relation to how directors, as agents of the company, about the fact that they don't manage the company in the best interest of the shareholders of the company. In that, management have been, allegations have been levied against management as by making making decisions that will not interest the company but will interest them. Making decisions that will not profit the company but will profit them. Making decisions that will not maximize the wealth of the shareholders but will maximize the wealth of the management. So that is what has become what we refer to as some allegations against management. And let's look at a couple of them. The first one is excessive remuneration levels. So one of the allegations is that management have cut a huge salary for themselves. So at the end of the year, they pay themselves a huge remuneration, a lot of bonuses, a lot of travel allowances, a lot of things in that case. So when you subtract all that, at the end of the day, you end up that the company is not making much profit in that case. But to solve this issue, that is why corporate governance requires that the company has an independent remuneration committee, which is a subcommittee of the board, that they will determine the salary of the senior executives of the company, like the board, the CEO, the board chairman, in relation to that. But if the people are still on the board and they are the same people determining their salary, then the allegation still stands in relation to that. Now, the reason why this allegation is there is that, you see, board of directors are business on their own, like they are working businesses, all right? So if they are working businesses, they could be earning more than what you are paying them. So definitely they will be cutting or proposing a huge salary for themselves. Next is empire building. Empire building. Chief executives having the aim of building as large a group as possible by takeovers, not always improving the returns on shareholders. So some board of directors or some board or management or chief executive officers just want to build group of companies. Yes, we have the Nhyira group of companies, or we have the PEX group of companies, and we are owning, we have ownership in 50 companies. And so what? If you have ownership in 50 companies, but it is not improving the returns or the shareholders, then what value is being added to the company? But this is another allegation that has been levied against management in relation to their behavior and not undertaking or working in the best interest of the agents that employ them, that is the shareholders. Next is creative accounting. Now, creative accounting is simply using creative techniques to improve the appearance of the published accounts and artificially boosting the share price. Now, this include issues such as capitalizing intangibles on the balance sheet, like development expenditure, putting value on the brand of the company, recognizing revenue on long-term contracts at the earliest possible term, and then not depreciating assets. All these things are referred to as what? Creative accounting. So instead of depreciating asset, they would depreciate it. Some intangible asset that they place value on does not make sense, like the brand, like customer list. Then income that are supposed to be recognized over a long period of time will be recognized in the early years, so that they will say, hey, this business is making profit, then it will what? Artificially boost the company and increase the share value of the company. So this is also another allegation that has been levied against management, not working in the best interest of the shareholders. The next thing is off-balance sheet finance. Off-balance sheet finance is, for instance, when the company leases the asset instead of buying it outright. Although this is now dealt with by the accounting standards IAS 17. So off-balance sheet finance has been one of the allegations in relation to what businesses used in the past, what management used in the past in order to affect the performance of the company. Takeover bids, that's the next point, takeover bids. There have been many instances of directors spending time and money defending their company against takeover bid, even when the takeover would have been in the best interest of the shareholders. So sometimes we are a company and another company wants to take over us, who want to come and buy us. Even though when they buy us, the shareholders are going to profit, management is going to say, hey, we can't sell the company. They are going to try whatever they have to try. They are going to convince the shareholders. They are going to do everything that is in their powers, is in their power to prevent the takeover bid or to disregard the takeover bid. Why is this so? Because if you sell the company, if we allow the company to be sold, it means we'll become jobless. It means we'll become unemployed in the meantime. So even though there will be salary package for us, we have lost our status and we have to go and start again from somewhere else. And what is the possibility that a company will be ready to employ us if we were in a company and someone came to acquire us? If we were as much as good, we wouldn't be allowed to be acquired. So that is another allegation that has been levied against management. And then the last thing there, it's about unethical activities, such as trading with unethical countries, using slave labor, spying on competitors, testing products on animals in relation to that. So all these are allegations that have been levied against management. So management sometimes have to spy on their competitors and look at, hey, what are they doing? What strategy are they, like insider information, what strategies are they putting in place? What new products do they want to launch? What new ideas are they working on? So that we can also do, it is unethical. Or if they are launching or about to launch a new product, they first test it on animal. What it means is that they deny the animal the right of existence, and all these things are referred to as ethical activities, and also relates to what we call activities of management which are not in the best interest of what the shareholders. So these are what we can talk about when we discuss the issues about allegations that have been levied against management or directors' behavior in the past. And in the next video, we will look at the agency theory in general and look at some other things in relation to the role and responsibility of CFOs towards stakeholders.